So there's this concept in anthropology referred to as ethnocentrism, and it's about individuals perceiving things in the world through the lens of their own culture and norms. So the idea is that to be purely objective, you need to remove yourself from your own culture. Moreover, if you want to understand someone else's culture, you really need to do the heavy lifting. So when we talk about the dangers of Chinese stocks, you really need to put aside your framework that's been used for years of investing in developed markets and start thinking about things a whole lot differently. And if you wanted to get a good background into the history of China, it can often be quite boring, but this is actually my favorite book, and it really has nothing to do with the fact that it's about China. It's just an incredible piece of literature, and it talks about three generations of women that grew up in China, and it's been banned in China, of course, and they don't like what it says because it's an absolutely riveting story, and it helps you understand where China's coming from, which is quite important. So today we want to talk about four concerns when it comes to Chinese stocks or investing in China in general. These concerns are VI structures, that stands for variable interest entity. We want to talk about the shadow banking system, Chinese accounting, and the CCP, the Chinese Communist Party. So before we get into that, I wanted to talk a little bit about my background relating to China. So I've always had a keen interest in the country and its growth prospects. And when I did my MBA in Europe, in the UK, I wanted to get over to China to have some exposure. So I did a exchange term at the university that you see here, this beautiful campus on the outskirts of Hong Kong. And then after working in London for a while, I worked my way over to Hong Kong, and my job there was to transition operational functions to lower cost centers. And one of those was mainland China. So I built an operations team there, among other places. And through that time, I also studied a master's in financial risk management at the institution you see here in the picture, the Hong Kong University of Science and Technology. I did my thesis on shadow banking. So I have some experience in that space. And the only thing that I learned was how little I actually knew, because China is a very complex place. And I think probably to truly understand it, you need to be fully immersed in the culture. So when we think about the bull thesis, that's pretty apparent. We don't need to talk much about that. 1.75 people out of 10 are Chinese. Since they began opening up in the 1970s, 800 million people have been lifted out of poverty. They're now spending 2 times that of US citizens on traveling. They have a very strong work ethic. Honestly, it's reminiscent of the sort of values that the US had in the 50s and 60s. And there's this notion of 996 that stands for 9 a.m. to 9 p.m., 6 days a week. And that's no joke. So it isn't just the companies that are making the employees do that. They do that because they're very ambitious and many want to get ahead, and they're competing against a lot of their peers that have that same sort of aggression. So the country is actually surprisingly green. They have a lot of solar installs. I think they're leading the world in solar investments and solar energy. There's no Google, Facebook, or Twitter that can distract people, though they have their own distractions. And interestingly enough, people think of Chinese women as being demure and shy, but they're actually aggressive as well. So 6 of 10 female billionaires in this world are of Chinese origin. So opportunity abounds there. This picture is actually a place called Juzaigo, and it's where the last of the wild pandas live. So guess who? The most successful businessman in the world, arguably could be Elon Musk. Maybe you could say Richard Branson, but this gentleman may not be so well known. He was rejected from Harvard Business School 10 times, as the story goes. There's other stories as well. He was rejected from 30 jobs. He applied at KFC in a group of people, and out of 25 individuals, he was the only one that wasn't hired. And I'm not sure if that stuff is urban myth, but it's interestingly part of the story. And he brought his first computer at the age of 33. He still doesn't know how to code. VCs wouldn't fund him, and he didn't sit there and complain that not enough VCs look like him. He simply bootstrapped his company with $20,000 his wife and his friend helped him raise. Well, he showed an ROI on that money of 241 million%. And that gentleman happens to be Jack Ma, who said, if you don't give up, you still have a chance. Giving up is the greatest failure. So Jack Ma was the founder of Alibaba. Here you can see this was taken from a piece we did, and I'm going to link to a fair number of research pieces for this presentation that we've done over the years. One of them will be on the bull thesis for Baba. And here you can see their revenues compared to Amazon, and more importantly, their profits compared to Amazon. It's a very profitable business, or so they say. And Baba, for whatever reason, has a profile that's hard to believe. And in our research piece, we've linked to a gentleman who provided some quite extensive critical commentary on the firm not too long ago. And he was asking questions about, for example, the productivity gap. So how is it possible that Amazon has a GMV per employee of 420,000 while Baba has 8 million, for example? And why did they spend, he likes to refer to things in terms of Burj Khalifas. He says why Baba spent $16.7 billion on PP&E. And he's got all these different questions. But the question that we had, or when our concerns were raised, was when Jack Ma was forced out. So he was one of the reasons that we had invested in Alibaba. And when we started thinking about our investment, which at that time was somewhere around 25% of our entire portfolio, this is prior to when we restructured for the current 36 tech stock portfolio we have today, we had written a couple pieces. And one was how to invest in the Amazon of China. That is the piece that describes the bull thesis. And then we have this article, A Big Bear Thesis for Alibaba Stock. And in there you can read about why we exited our Baba position. And at the time we wrote that piece, we were already exiting. And here on the right, you can see market cap comparison between Amazon and Baba. Amazon's actually around the same. Baba's about a third of what you see there. And a bit of luck here. If you look at the horizontal dotted line, when we sell a stock, we don't go and sell everything all at once and try to time the market. We do so slowly. So you can see that horizontal line represents the time that we started selling to when we completely exited our position. And the vertical line shows when we wrote that piece. So we had exited our position somewhere in the range of $270 a share, which turned out to be a pretty good deal, and that remains to be seen. However, the biggest concern that we had with Alibaba wasn't the bear thesis that was posed by that gentleman who also has a rather complex theory about how China is trying to screw over the US. The main reason we exited Baba was because of the variable interest entity. This is very important, and we talk about this quite a lot in the context of Chinese firms, and it's what spurred us to do this presentation. So, long story short, Chinese law prevents foreigners from directly investing in Chinese firms. So they crafted this structure, and it involves usually a firm in the Cayman Islands, and there's lots of lines, and there's lots of different shell companies, and it's very convoluted and difficult to understand. But one thing is quite clear about the VI structure. It does not give the holder legal right to shares of the underlying company. Numerous warnings have been issued over the years by all kinds of entities. You can do a quick Google search and see quite a few recent warnings. And people will say things like, well, how come BlackRock invests in VIs? Well, we did a piece recently that talks about institutional ownership, and a lot of times BlackRock doesn't even know or care to know about what they're investing in because they're simply trying to follow an index. So VI structures have existed now for quite a while, and on this next slide, you can see an example of some of the firms here, mostly Chinese tech firms. and there's about 445 mainland companies that use VI structures to trade here in the United States. You probably see some names on here you recognize. You've got JD.com and, of course, Alibaba. And this Council of Institutional Investors had published this great piece in 2017 warning investors that it's a bad idea to be investing in shell companies that don't give you any legal right to the shares that you think you're holding. It's as simple as that. So recently, VIs have been in the news, and we wanted to break that down and understand where are things today. So we recently had quite the back and forth with somebody on Twitter who was trying to claim that they could peer through the tea leaves of the VI structure and see that everything was okay. Well, it's not okay. Here's an article by the South China Morning Post that suggests everything's kosher when it's not. It says investors likely to cheer clarity on VI companies. Well, if you look at what happened here, they simply said that companies can list overseas as VIs as long as they abide by compliance rules. Doesn't say anything about companies already listed overseas. And moreover, it also says that companies can list overseas without using a VI structure. So that kind of removes that problem. However, there haven't been very many listings because of a spat, an ongoing spat between the United States and China. So when we want to look at the legality of something, we want to consult with people who have extensive subject matter experience. And our idea was, well, we'll go find a lawyer out there that has a lot of experience and find out what they think. Well, this gentleman here, Fa Chen, is a associate teacher at the University of Cambridge. So he studied at Harvard Law School. He was formerly a Chinese judge in Beijing, an in-house lawyer at Alibaba. He probably knows a whole lot more about the laws in China and the United States surrounding VI structures than we do because he's studied it extensively. So, update on VIs. Triggered by Didi's US listing in mid-2021. This is when things kind of kicked off, and Didi is a ride-hailing group in China. The Chinese authorities were pissed off about something, and they decided that firms that list using VI structures in the States need to have a cybersecurity review. I believe it's if they have more than 1,000 accounts or something like that. So in response to that, the SEC asked prospective Chinese issuers with VI structures to carry additional disclosures to bring VI risks to investors' knowledge. This led to a sharp drop in US listings, and the end point is that Chinese authorities remain reluctant to clarify the legality of the VI structure. And here's a recent piece by that same gentleman, so April 2022, and he makes some very good points here that the strategic ambiguity of the VI legality can help Chinese authorities maintain regulatory flexibility to leverage economic development, but with legal risks to foreign investors. In other words, they don't have to buy the cow, but they can have the milk for free, as they say. Chinese VI structures present multifaceted legal risks to foreign investors. Why? Because in the event of invalidation of these structures, foreign investors could find themselves lacking effective remedies both at the local level here in the States and international levels. So that's a big problem. That's not a risk we're willing to take in light of the recent spat between the United States and China, and the relationship between those two countries has never been worse. So now is probably even a better time to sound the warning horn than it was when we did that several years back. So just wanted to touch on this last bullet point, quite interesting. As you would expect, there's a discount for VI structures, and this research paper claims that it's titled When Enron Met Alibaba, The Rise of VIs in China. It claims that VI structures are discounted by around 30% to account for the risks, and that makes perfect sense. Now, the SEC has, of course, warned investors. They did so recently in July of last year, and here's what the SEC chair says. He says, I worry that average investors may not realize that they hold stock in a shell company rather than a China-based operating company. So the VI structure isn't something we want anything to do with. It just holds too much risk. But we'll take it a step further than that. Even if VIs didn't exist and these firms traded as legitimate ADRs, we still have a lot of concerns about how business is conducted in China. And one example I'll give you is this report by Wolfpack Research on EHang. And I'm not pointing to the contents of this report, though. If you're an investor in EHang and you read this, you ought to have some concerns, and how people can just gloss over it is remarkable. So what I want to point to here is the level of due diligence this firm went to. And you can see here, they shorted it at a stock price of $124. Well, right now it's trading around $7 and a market cap of about 440 million compared to the 6.7 billion market cap it had when they published this. And here they says the security guard is the hardest working employee we saw during our investigation. The guy's sleeping. And they went through, they knocked on doors, they walked into warehouses, they had boots on the ground. That's how you do due diligence. If you want to invest in a Chinese firm, that's what you do. And sophisticated institutional investors hire people to do that because you have no clue what's going on in China, because it's a scary place. Shadow banking risks in China. Shadow banking is this entire collected enterprise of banking services that exist off the grid. So these financial institutions offer bank loans in disguise, and it's common for firms to take these loans and leave them off their balance sheets. The Chinese have a very I say they have a propensity to take a lot of risk. So we tried to sell them risk management software for a long time, and we weren't able to make much headway because they couldn't understand why the heck you would want to minimize risk. So the recent article here by Reuters, looks like it was last month, says, well, the shadow banking sector has been reduced by $4.3 trillion as of the end of June from its historical high. That's incredible. That's a huge amount of money. And this is the Chinese government saying this for what it's worth. In 2020, shadow banking, so this is the outstanding loans that are more or less on the black market, was somewhere around $13 trillion. So there's an entire, you could compare that to here in the States, you have legalized cannabis and you have the black market. It's kind of similar. So, except it's the financial industry. That's not good. So shadow banking is a huge risk, and you never know what sorts of exposure a firm might have that you don't know about. And we're not just talking about over-the-counter equivalents. We're talking about large firms. Now, the other thing is how corruption affects Chinese firms. So this study is quite interesting. They used a unique data set of around 15,000 Chinese firms. They investigated entertainment and travel costs, a standard expenditure item in the accounting books of Chinese firms. Of course it is. Drinking with your colleagues. As a matter of fact, if you go to do business with a Chinese firm, they want to take you out and get you drunk because that's how they find out about your character. It's very common to go out and get wasted. When you stay at Chinese hotels, I'm not talking about shoddy ones, 4-star, 5-star hotels. Anybody knows what the red rope trick is, you know all about what's going on at large Chinese hotels that are large brand names. Nobody would suspect what's actually happening. I think recently the BBC covered it, oh, shock and awe, that there's brothels in every single hotel in China. Well, that's part of entertainment when it comes to clients and customer relationships. So there's a lot of things going on that would be shocking in the West, but that's just normal. And there's a lot of corruption involving the government and whose palms you grease. And in this study, they said, in our empirical analysis, we find strong evidence that ETC consists of a mix that includes expenditures on government officials, both as grease money and protection money, et cetera, et cetera. Chinese firms in their sample spend about twice as much on ETC as Korean manufacturing firms. So there's a lot of things going on that are part of normal business in China that are shocking to the West, and they can create problems. You don't want to piss off the wrong government official. You can create a lot of problems for your company. And you can look at the creative accounting that happens over there. I think Deloitte was actually sued at one point for signing off on some things that they sort of turned a blind eye to. And here you can see this firm, the China's Starbucks Luckin Coffee agrees to pay $180 million penalty to settle accounting fraud charges. They were fabricating more than $300 million in retail sales. They had a fake operations database. This sort of stuff is not uncommon in China. It's a very different place. And a lot of the reason that this exists is because the people in charge are corrupt as hell to begin with. So the Chinese Communist Party, they get a lot of perks. So China's so heavily subsidized, they say as much as 30% of the average company's profits is derived from the government. By the way, this picture here is from EHang. It's a beautiful old town, a little bit touristy, but still quite interesting. I believe it's in Sichuan province. And it's next to impossible for business to succeed in China unless it's linked to the government. So you also have shadow financing that comes from big state-run banks to fund certain job-creating development projects that benefit somebody in the Communist Party. So they recently enacted this mandated cybersecurity review for overseas listings. And of course, that's kicked off the spat that they have with the US. And there's a big difference, of course, between foreign investors and US investors when it comes to perceptions, but when it comes to foreign investment, it's pretty much all treated the same. So the question that you might have, certainly one that we have, is, well, how do you actually make a legitimate investment in China? Well, to do that, we can turn to Hong Kong. So when you look at the trading that's happening in Hong Kong, you have three classes of shares. The safest on the list here are H shares, traded on Hong Kong's exchanges, regulated by Chinese law, and freely tradable by anyone. So you can start there. And here we pulled a list of the top 10 according to MSCI's current H shares index as of last month. And interestingly enough, look who's in third place. Well, there's BYD. So we'll certainly have to take a closer look. It's been a while since we looked at BYD and their electric buses. So also on here, you can see quite a few banks. If things go pear-shaped in the Chinese financial markets, then maybe this isn't the best index to hold. So you can see just how risky investing in China is, not to mention when you start talking about tech companies, and furthermore, you talk about tech companies listed as VI structures. So our belief, our conclusion is that we avoid VI structures with no exceptions. We don't sit there and try to parse out the lines and figure out which box connects it. We don't do any of that. And if you have any doubts, go into the SEC filing, do a Control F, type in VIE and hit enter and start looking at what they say about their VI structure. And they're going to very clearly tell you you have no legal right to the shares that you think you have a legal right to. So that's very important. And once you get past that, let's say they solve the VI problem, which hopefully they do, you also have to worry about the CCP, shady accounting practices, corruption, shadow banking. These are a cost of doing business in China. So do you just throw up your hands and say, well, that's just how it goes? Probably you do, because it's just a different animal. And the question is, well, is there enough opportunity to offset the skimming, the systemic risks and all that, the corruption? Probably. So China has a lot of potential. But for Chinese tech, is it just too risky? Probably. So maybe the safest thing that you can do is invest in an ETF. That's the safer way to play the panda, or not. So please leave your comments in the comment section. Make sure to subscribe to our channel. Thanks so much for taking the time to listen to this presentation today.